Hi guys, welcome back to another video. My name is Sean, and today we're diving into the question on every Singaporean's mind, which is, can Singapore's property market keep going higher? To answer that, we're taking a deep dive into Singapore's property market. So here's the context. Prices have been sky high, climbing steadily for 5 years. In 2024, HDB resale prices surged 9.6%, nearly double the 4.8% jump in 2023. Private properties up 3.9%. But hold up. With talks of a recession, rising unemployment, and a slowing economy, how high can this bubble go before it pops? And now, with Trump's reciprocal tariff shaking global trade, is a crash actually coming? Let's find out. And before we start, check out my website and join my newsletter to discuss or ask questions in the link below. First things first, to predict the future, we gotta first rewind. Singapore's property market has seen dips, always tied to big shocks or property shifts. But check this out, we're comparing GDP changes with property price shifts from 1975 to now. 5 major crashes stand out, each with its own story. So now let's break it down in style. Firstly, in 1981, the approved residential property scheme let folks use CPF savings to buy private homes for the first time. Demand exploded and prices spiked overnight, but the government couldn't stop the bubble. By 1984, construction was oversaturated and Singapore hit its first post-independence recession in 1985. Businesses shut down, unemployment spiked, and confidence tanked. The result? A brutal 40% drop in the property price index over 20 quarters, the longest and deepest crash in Singapore's history. Fast forward to 1996, cooling measures like 80% loan-to-value caps, ban on SGD loans for foreigners, and early seller stamp duty hit the market. Then, the 1997 Asian financial crisis slammed in, with currency devaluations and rising unemployment hitting all at once. Prices dropped 30% over 10 quarters subsequently. But recovery was quick, actually just 6 quarters. Next off, we had the dot-com crash in 2000 and 9/11 in 2001, which rocked the globe. Singapore's GDP shrank and unemployment hit a 15-year high of 4.7%. The property market, of course, took a 21% hit over 16 quarters, with a 4-year recovery. So you can see this trend right now that recovery tends to be a lot shorter than the bear market. In 2008, we had the global financial crisis. This is when public and corporate debt ballooned, and this brought a 26% price drop with the 2008 global financial crisis. But buyers saw Singapore as a safe haven, and the dip only lasted just 5 quarters, followed by a massive 53-point index surge from 2009 to 2013. I guess you're seeing some sort of trend here that it always recovers and we do some sort of quantitative easing. Next off, something more recent was the 2020 pandemic dip. This caused a tiny 1% drop, actually lasting 1 to 2 quarters. Show flats closed, viewing stops, but price bounced back even faster than before as lockdowns lifted and new money flooded in. So you can see by now that the trend is getting shorter in terms of our bear market and we're recovering a lot faster. So in terms of lessons from history, what is the deal, right? What can you learn from history? First, crashes are normally tied to external shocks like recessions or crisis. Second, dips are getting smaller and shorter like I mentioned, thanks to Singapore's safe haven status and slick cooling measures like the total debt servicing ratio, TDSR, which keeps borrowing in check, but also a lot of free money that's being printed in the global economy system. So since TDSR, price swings have chilled out a bit, showing strong fundamentals. From 2013 to 2022, Singapore's property market was actually more stable than Hong Kong, Sydney, or London. So in terms of the current situation, let's get a view about 2025. This is of course a volatile year, and if you've been following the markets, you'll know that Trump's reciprocal tariff just went through a week back. Markets are still extremely shaky here. Another thing to consider is that he could, of course, taco, as the saying goes. Trump always chickens out. And if you don't know how long these tariffs last or take to resolve, and if he even backpedals on them. So the market's obviously been showing some signs of cooling, no doubt due to the higher interest rate environment the last 3 years. Private property prices actually grew just 0.5% last quarter, down from 0.8%. HDB resale growth slowed to 0.9% from 1.6%, and transaction volume down 40% for private homes and 10% for HDBs. Buyers are of course cautious. Another thing to note is that the price to income gap is widening. From 2020 to 2024, private home prices actually jumped 33 to 40%, but medium income only grew 23%. This is to say that wage inflation is actually not keeping up with housing inflation. So the price to income ratio actually hit 14.6 times in 2024, making homes less affordable, especially in the global and mass market. Globally, trade is also slowing down, and Singapore's 2025 GDP forecast is down to 0 to 2% from 4.4%. So there's a real possibility of a recession coming soon. I know that's been said for the last 1 to 2 years since we had COVID, but growth is actually slowing this time. And we don't seem to have any easy money conditions coming, with the rate cuts not really happening, with Trump and Powell fighting it off. So tariffs could of course push up inflation and construction costs, making homes pricier even as demand cools. Still, of course, tariffs could shake things up. If trade wars escalate, job losses and tighter credit could also hit demand in terms of property and in terms of our spending. Knight Frank, a notable global real estate consultancy, warns this might be just the calm before the storm, and it's like the tipping part of the iceberg. Okay, long story short, I'll sum this up for you in a TLDR. In my opinion, don't be hasty into buying $1 million HDB or private property or executive condo just because your friend or real estate agent says it's a sure thing. You gotta think a bit longer term. There's this saying with property that don't wait to buy and wait. But that's something that a lot of real estate agents chime with, and they of course have their own biased reasons to encourage property buying. But at least for me, I think cyclically we're still very overheated in terms of the equities market and in terms of the property market. So if you have the time frame, you're a little bit younger and you're single, blah blah blah, there are better investment vehicles with higher yield and lower risk to park your cash in. That's the story of Singapore's property market. Will it crash or keep climbing? Only time will tell. But I hope this gives you a more nuanced and educated perspective. If you like this sort of content, smash the like button, hit the like, share and subscribe, drop a comment below on what you think, agree or disagree, and check out my website to learn more about the property market. I'll catch you guys next time. Bye!